What's going on, fellow income investors? Welcome to my channel. I am the covered call guy, and on this YouTube journey, for those who are new, my goal here is to create $120,000 in annual passive income. I'm currently holding 6 covered call ETFs. Right now, my projected annual dividend slash distribution income is about 70 grand a year. Translate to about 5.8k a month, 1.3k a week, $191 per day, and about $7.99 per hour. Legal disclaimer before we start this video: this content is for informational and educational purposes only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own. It may be inaccurate or incomplete or just flat out wrong. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I am just some random idiot you found on YouTube, and I could be completely wrong. All right, now with that out the way, let's get started. All right, today's video, I'm gonna be omitting, I might be completely wrong about rate cuts, right? So a lot of things have changed. A lot of things are looking like, hey, we're probably not gonna go any lower. So we're gonna have to be navigating the higher for longer regime. Okay, we're gonna be asking ourselves, if the Fed holds, here's exactly how you extract the massive wealth, right? This is how I think the game plan should be going forward. All right, so this is my core thesis for this video, right? So the biggest mistake income investors can make right now is positioning for a rate cut. I don't think we're going to be going for rate cut. It's going to be very, very scary if we do go for rate cuts with all these things happening, right? We're kind of entering the stagflation type of scenario here. I don't think we should be going for rate cuts, right? But who knows, with the new Fed chair that comes in about 2.5, 3 months that, you know, Trump is going to pick. All right, so in this regime, cover call strategies gain a massive structural advantage, in my opinion, making this the most favorable environment in over a decade. That's my core thesis, right? I'm going to try to spin it to make it positive here. All right, so let's look about the ZERP hallucination, right? That's over. All right, all this means is that, right, free money, right? The era of free money was a fever dream, and if you got into it, great. If not, then all right, let's just brace ourselves here, right? But for the most part, we are all awake now, right? A lot of us are realizing about what, you know, the sticky inflation, geopolitical chaos, right? Slam the doors shut on these rate cuts, okay? It is a fantasy now, right? We are currently sitting in 2026, and the risk-free rate is a massive hurdle that is brutally exposing weak portfolios. Guys, we have to adapt or get left behind. Okay, the explosion of cover calls. Okay, let me get into this a little bit. Of course, if you're you know, into the channel and you know, you're looking at my videos, right, subscribing, I am the covered call guy. So let's talk about a little bit of cover calls, right? So why do we choose cover call ETFs or cover call stocks, right? Why? Because it's not just a bond proxy, right? Wall Street markets cover call ETFs as a simple dividend or bond proxy, but reality they are absolutely not, right? They're a highly engineered mathematical mechanism designed specifically to monetize equity volatility and capitalize on the cost of carry. Of course, it depends on what you pick, all right? There are a lot of slop out there, so beware. Right, and then mathematical shift here, right? Because fixed income give us zero yield, right? Especially for those now that are entering the retirement stage or have retired, right? Right, fixed income is absolutely getting destroyed by inflation, right? These derivative income strategies have seen explosive multi-billion-dollar asset growth. Okay, cover call has been pretty much, the asset under management has been exploding. Okay, when rates stay high, the math behind these options fundamentally alters in your favor. Okay, that is great for us cover call ETF investors, income investors. All right, this is possibly a good thing, right? All right, so why 5% rates or your secret weapon? Okay, when the risk-free rates sit at 5%, the math of the stock market fundamentally breaks in your favor. Okay, this is how I'm gonna spin it. This is my narrative now, right? Maybe you agree, maybe you don't. Okay, high rates crush equity valuations, creating a flat, choppy market where traditional growth stocks stall out and die. If you agree with that, this is a good thing. If not, then, you know, explain to me why, because I'm just using data right now, right? But for cover call ETFs, that exact same 5% rate mathematically forces call option premiums to explode higher. We're going to get paid massive double-digit yields precisely because the rest of the market is suffocating. Okay, remember we're selling fair here. Okay, what if rates hold or spike? So in my opinion, if rates hold right here about 5%, give or take, it is a cash flow golden age where we collect massive premiums while the market chops sideways. Okay, but what if rate spikes? Well, if inflation forces the Fed to hike again, we enter the ultimate tail risk scenario. This is where your NAV will take a hit from the market drawdown, but option premiums will violently explode upwards, right? The net result is unprecedented income generation for your portfolio. Okay, let's look at the ultimate cheat code, right? I don't know how you pronounce this or it's the correct way. I'm just going to say roll, okay? Is this regime good or bad for cover call investors? I'm going to say it is phenomenally, unbelievably good, okay? Why? Because of the simple math rule and options called roll, okay? That guarantees call premiums increases when interest rate goes up. So when everyone else is crying about expensive mortgages, your cover call ETFs are mathematically forced to pay out richer yields. Okay? Why? Because fear literally pay out bills. Okay, this is what we're selling, right? We're selling fair. Okay, we monetize the fair. So stop looking at the VIX like a nerd and start looking at it like a cash register, right? This is where the money is. Okay, high interest rate bleeds massive macroeconomic fear, and fear drives up the VIX. I talked about this a lot. You're the casino, right? When the VIX stay elevated, option prices across the entire market inflate rapidly. Okay, you are the casino selling fear insurance and the business is booming, and for the most part the house always wins. All right, okay, I talked about my counterpoint, the good side, but this is the strategy's kryptonite, right? Because I'm gonna be brutally honest with all of you guys, right? This is unfiltered, my unfiltered truth, and I'm gonna tell you how it is. Doesn't matter if you own it, I own it, nobody owns it, everybody owns it. I'm still going to talk about it. The good, the bad, the ugly, the beautiful. Okay. This strategy does have a fatal weakness. I think if we get a miraculous soft landing where both inflation and volatility collapse simultaneously, right, our premium income will vaporize overnight because a low rate, low volatility bull market will completely destroy our double-digit yield, right? Regardless of what the fund promises, okay? This is the only scenario that will truly kill us here. Right? What should we do though, right? Of course, I say this all the time, trash the 100% at the money overrides, right? Dump these Gen 1. Do not touch Generation 1 funds like QYLD, right? Don't touch it. Don't go near it, okay? They cap all of your upside but force you to eat 100% of the market crash. You are mathematically guaranteeing your portfolio value will erode over time. Dump them immediately. Low rate, high rate, no rate, just dump them. Okay? Buy the tax hackers, right? I talk about this and I stress about this. These are the Section 1256 cheat codes, right? Put your money into Generation 3 funds like SPY for your taxable account, right? They write broad-based index options that trigger a massive 60% long-term tax break. You significantly keep more of your yield, right? Leave more room for the NAV to grow, right? This is the ultimate structural cheat code here, right? High rates won't save garbage funds, okay? This is where it gets very, very dangerous here because if it's low rates, everybody gets to borrow cheaply, but once the rate goes up, you will start seeing companies start dying out rapidly, okay? Just because we're in a massive cover call tailwind doesn't mean you can buy any high yield garbage you see. If a fund pays out 12% but only earns 5% in premiums, well, it is literally cannibalizing your own principal to pay you, right? Your NAV will bleed out. Your absolute income will drop every month, right? Don't be a sucker for optic yield. Never, never, never. Okay, you are not screwed. Okay, you are the shield here, right? So that's one of the questions that I've asked myself, right? Am I screwed? No, I think in this environment we pretty much act very defensive. So right, are income investors screwed in this environment? Absolutely not. However, you are if you did not ditch the outdated 60-40 model. That's where I think it's like, oh, this is pretty outdated, in my opinion, of course, right? In this chaos, stocks and bond does crash together, but your cover call acts as the ultimate shock absorber here, right? Build, you could build something like a 60-30-10 portfolio, right? 60% growth equity to compound, 10% T-bills for safety, and 30% cover call to aggressively monetize the volatility, right? This is something you can build around as a shield here. Right. So what to buy for the plateau, right? Of course, I always stress this again. Active out of the money always wins in any scenario, right? If rates hold at 5% and the market chops sideways, you need active out of the money cover call ETFs. Buy funds that dynamically place strikes above the current price to capture moderate growth while harvesting elevated premiums. Okay, this is the 5% barbell, right? Pair this with a short duration T-bill to lock in a completely risk-free 5% baseline, right? I talk about this is where this is kind of like your dry powder here, right? This is a good barbell approach, right? Pretty bulletproof for a stagnant market. All right, let's talk about the 2026 tail risk survival guide. Okay, of course, this is going to be my survival guide. Right? Why? The biggest risk today isn't just a standard recession, right? It is a stagflationary crash where inflation stays high, but the economy breaks. And we're kind of starting to see some, the cracks are showing, right? Because prices are still high, nothing's going down, and people are losing jobs at the same time. So if this happens, right, traditional bonds won't save you because rates can't be cut to zero. Okay, this is where the 60-40 kind of really breaks apart, right? Your only defense is the massive volatility spikes that will instantly supercharge your cover call premiums, right? This is where we use the massive cash flow injection to aggressively buy the dip or hold cash, whatever you feel safer in. All right, so the playbook. All right, this is my opinionated playbook, okay? So let's just say the rates spike above 5. Let's go 6% plus, right? This is where you should probably get into short duration T-bills, right? So if the Fed is forced to hike rates to 6%, 8%, right? Long duration bonds will get slaughtered and unprofitable tech will collapse. Lock in the yield, right? You must aggressively buy short duration T-bills to lock in that massive guaranteed yield. Mega cap covered calls, okay? I would heavily allocate to active cover calls on cash-rich mega cap tech companies. Harvest the explosion. You will harvest the resulting volatility explosion while hiding in quality balance sheets. This is where you will start seeing which company will fail, which company will die pretty quickly. And like I said, I buy these strong, high quality companies. All right, playbook. If the ultimate avoid list, all right, liquidate at the money funds, right? Why would you even hold these? It doesn't matter what the rate is, right? If we get locked into a high rate death spiral, you have to instantly liquidate any cover call funds that writes 100% at the money. You will get suffocated here, right? Avoid synthetic traps, right? Furthermore, of course, avoiding synthetic traps that promises 40% payouts on highly volatile individual stocks. I'm pretty sure a high rate environment will absolutely destroy synthetic cover calls. Mathematical destruction here, right? They will mathematically self-destruct when these underlying stocks mean revert in a panic, right? Ultra high yield synthetics will do this. Okay, stick to quality. Stick to broad index funds that use out of the money strikes. This is the only way, because now you're at least able to capture the premium and able to capture some of the run if it ends up running. Okay, my last and final words to you is stay strapped with cash, okay? Because hoping for Fed to save your portfolio rate cuts is a desperate loser's game. You should never place your bets on the Fed because you never know what's going to happen, okay? You're essentially kind of gambling at this point. Because in a high rate, high chaos regime, right, I'm gonna say this is the greatest wealth extraction environment for volatility sellers in modern history. This is pretty, I'm trying to spin this, might be good for us, okay? Stop crying about expensive mortgages, expensive groceries, expensive this, expensive that. Let's focus on what we can capture here, and that's optimize your tax wrappers and let the macroeconomics chaos pay your bills, okay? Stay strapped with cash flow, and we can dominate the plateau here, okay? Don't worry about anything else. I could have been wrong with the rate cuts, and, at the end of the day, if the rate goes higher, you know what? If I'm right about this, we already have a game plan, right? If not, then we stick to what we're already doing. So hopefully the information here was the video here was informational, right? So you got something out of it. I made this video because, you know, it's starting to look like we're not getting a rate cut, and I'm just starting to look at what happens if the rate doesn't cut. So what happens to income investors, covered call ETF investors, and that's what made me think. So I think we'll be fine. Pretty sure we'll be fine. If not, then I'll carry on and continue to do what we're already doing. The opposite of this video, right? So hopefully we'll be all right. But in the next 2-3 months, I think in the next 2-3 months, I think around May, Trump would switch the Fed chairman. So we'll see how that starts out. I'm gonna have to make another new update video. Thanks for watching, guys. Stay tuned. Catch you guys on the next.